So the purpose of this paper is to calculate neutral rates for these advanced economies, and how do we approach that? So most of the analysis, as you probably know, focus more on savings and investment decisions, country by country. But the issue is that if you look only at savings and investment on the aggregate, you would think that you had similar movements in return of all different assets. And there is a lot of recent evidence that the real returns on safe assets have declined, as I showed in the previous slide, but the real returns on risky assets were more or less constant. So there are just the first paper was Gom and some co-authors in 2011, but there is even a recent paper by Marx and other colleagues in a special issue of the JME that was out, I think, 1 or 2 months ago. And the key idea is now, I mean, it's how could we explain this decoupling between the safe and the risky returns? And also, because most of the studies look at country by country, it kind of overlooks the international determination of interest rates and this arbitrage that we could have between interest rates of different countries. So to address these two issues, we focus on supply and demand of sovereign safe assets. And to do that, we build a new measure of supply of sovereign safe assets that I will talk about later. And then, I mean, if you look at only, let's say, this particular market, if you have a lower supply, you have higher prices, you have lower yields and lower rates. So this is more or less the logic behind this. And also, we account for global spillovers in neutral rates. So estimate neutral rates for 11 advanced economies since the 60s until 2019. And we include simultaneously many determinants of neutral rates. So you'll see later that we not only look at this measure of supply of safe assets that we have here, but also we look at other measures such as demographics, productivity that have been studied previously.
Sure, very quickly. Just clarification. What is the definition of neutral rates you have in mind? Just to be everyone on the same page.
So here we are looking more at the let's say the long run neutral interest rate. So the slow moving neutral rate. There is also, I mean, another definition, which is that the short run neutral rate, which mainly makes the output gap zero and inflation stable. But this is more a long run perspective, not really a very short run perspective. Although, I mean, you'll see later in our empirical analysis that we do a kind of trend cycle decomposition. So in a sense, we are kind of looking at both short and longer term, but our definition here is the trend real rate. So it's kind of a long-term neutral rate, not short-term.
So in simple models, it's 1 over beta. That's what you have in mind.
Yeah.
But in more complicated stuff, they not beta.
Yeah, that's it. Yeah.
Okay, gotcha. Thank
you. Just one small thing, which is, I mean, yeah, it would be like the 1 over beta, but where the beta is like time varying, right? It had followed some sort of time varying rule, but yeah.
So the main takeaways are that, one, this measure of supply of safe assets is an important determinant of neutral rates. So on average, when we do a variance decomposition, we get that 37% of the variance is explained by this measure. And also that after the global financial crisis in 2008, the increase of the availability of safe assets has actually prevented neutral rates to decline more, which is something that, I mean, there are some recent paper by Larry Summer and Lucas that point to the same direction, but using a very different methodology. We also corroborate the global savings growth hypothesis, but I mean, that was first proposed by Bernanke, but I mean, several other people expanded on that. And that this accumulation of foreign exchange reserves in 94, the mid-90s, let's say, this lowered the availability of safe assets for the private sector, and then it reduced neutral rates by up to 65 basis points. And finally, we find that the global spillovers are also important determinant of neutral rates. So if you look at one particular country, the rest of the world productivity slowed down and demographic transition had effects. And for example, for the US neutral rates, it will be something like 85 basis points in since 2000. And they also help to explain why the neutral rates co-move across countries. So the literature I think this is for this audience should be very straightforward. But I mean, we also obviously talk with the literature of determinants of neutral rates. I mean, which, as I said before, is largely motivated by savings and investment decisions that look at demographics, productivity, and some papers look at safe asset scarcity, like this paper by Del Negro co-authors and Glick. And as I said, what we do is we propose this measure of supply of sovereign safe assets and to quantify how important it is. We evaluate this global savings growth hypothesis, and we show how important are global spillovers to determine the neutral rate. We also talk to this safe asset scarcity, and then, as I said, Banco, and then several papers by Caballero and co-authors, and we just corroborate the theoretical results that safe asset scarcity could be an important determinant of interest rates. And we also talk with this literature about the global co-movement neutral rate, which, again, Caballero wrote about that. Rich Clarida has a paper on that, Del Negro, Kylie, Obstel, and many others. And we show that this co-movement comes from three different determinants. One is a global factor, which is the safe asset supply and the convenience yield. The synchronization of local factors, and then global spillover. So, everything is important to explain this global co-movement. This is something that I'll talk about a bit more in the end.
Amen.
Yes?
Yes, hi, Sam, Andres Fernandez here. So just to clarify on one of the first key takeaway. So one of the points that Caballero, Gurinchas, and Faris stressed in their sequel is that during the global financial crisis, some assets that were deemed by the market as safe were destroyed or were reclassified as risky. Do you also, are you also going to address this at some point?
You see, when I go to this item 2, which is how we show how we measure the supply of safe assets, you see that what we decided to do is we will focus mainly on U.S. treasuries as the global safe assets, and then we have some robustness, including German bonds, French treasuries, and also UK gilts. But we don't look at this one that were kind of destroyed, like they say, because they said, for instance, that Japan was downgraded, Italy was downgraded, Spain was downgraded. We take this as an indication that they weren't safe actually ever. It's just that the people just realized that they weren't safe before the financial crisis, so they were downgraded. So we didn't include that in our analysis. So that's the way we approach it. But I'll take about the building of the measure. I will talk more about the building of the measure in some slides.
All right, thank you.
So we have a very short theory section, and we borrow from Krishnamurti and V.C. Jorgensen paper in the JP 2012 that talks more about the convenience yield on safe assets. But the idea is that, if you have a utility that, depends not only on consumption, but also on a function V that depends on the benefits from holding safe assets, and the benefits will be related to liquidity, for instance, you're reducing transaction costs, or some institutional arrangements related to their safety, like, some portfolio shares of retirement savings must be allocated in safer assets. And then, if you solve this very simple model and you see that the neutral rate would depend on the growth of the economy, on the, we call it delta here, but it's beta in Ernesto's language, and you see that it also depends on this component. And here, if theta, which is the supply of safe assets, is low, then interest rate go down. And we also have a preference shock. And the main idea that we have here is that the marginal buyer is the private sector. So we will focus on the safe asset availability to the private sector. And this will more or less guide how we build our measure of net supply of safe assets, that I'll talk about it later. This preference shock could represent other drivers of safe asset demand. Let's say regulatory changes since the global financial crisis. We saw some different regulatory changes, especially for the banking sector, that made they hold more safe assets. It could be preference shocks that lead to higher precautionary demand. And we could also interpret, for instance, demographic changes as preference change, in a sense that, I mean, if you have population aging, for instance, it's expected that, I mean, as you age, you hold less risky assets and more safe assets, and this could actually, I mean, increase the demand for them and make them more valuable, and then make the interest rate go down because the price is going up.
May I ask you a quick curiosity?
Sure.
Please, the previous slide. Could this preference shock give you the decreasing trend in real interest rates? You don't need to assume that these shocks are going to be stationary somehow?
You see that we have trend shocks and stationary shocks, so you have both. So suppose I'll give you one example: the aging thing. The aging, what we'll give you is that, I mean, as the population ages, the pyramid of the population goes to older people, and then during time, the demand for safe assets is increasing, right? Just because, I mean, you have to. So this could give you a trend, and at some point of time, it stabilizes, right? But it could be a long run trend. It doesn't need to be just a short run shock. That's the idea here. We are not. I mean, you'll see later that in this particular presentation, we are not addressing the shock. We are more related to the theta, which is the supply. But I mean, I'm giving you the idea, and then we are actually working now on some revisions that might have some of this preference shock that would be here and could affect the trend real rate. But that's the idea, more or less. It doesn't have to be just a transitory shock.
Okay, so basically it means that besides consumption capital motives, people like sometimes more safe asset than some other times.
Yeah.
And so far there is no trend on that.
So far, no. But
okay,
it could be.
Good. Thank you.
So how do we select how do we define our measure of safe assets? So I mean, I think it's pretty obvious that safe assets is just a simple debt instrument that's expected to preserve its value during adverse systemic effects. This is Caballero and all co-authors' papers. And how do we select a country? The capacity of a country to produce safe assets, its level of financial development, fiscal capacity, track record of the central bank, and constraints in the financial sector. And we also, I mean, for the baseline, we also took into account this dominance of the US dollars in global trade, financial, and monetary systems. So the baseline will focus on US treasuries. The extent, I mean, we have a robustness that looks also at Germany, France, and UK together with the US. The results are mostly the same. We decided to focus on US treasuries because we have very granular data on who holds the US treasuries, and of that, it comes from what they call the TIC data. So we decided to focus on that. And because also, I mean, as I said, I mean, the US treasuries are mainly the global safe assets. And our measure of net supply of safe assets that we start with the gross supply of US treasuries. And as you will see, if you only looked at that, you see that it's always increasing. So actually, what's scarcity here? Because you see that, I mean, they are always increasing. But then when you take out what doesn't go to the market, so there is a huge chunk of the treasuries that cannot be bought or sold in secondary market. This is Medicare trust funds, Social Security trust fund, other things. I know that, I mean, my experience, for instance, I'm from Brazil, so my experience in Brazil is that we don't actually issue bonds and put in a fund to do that, but in the US they do it. So the growth is kind of misleading in a sense because they are just, issuing treasuries to pay for this obligation that they have in the future. So this is one thing that we take out. And then in this version, we take also out the foreign international reserves because we are really focusing on the supply available to the private sector. And in a sense, we are assuming here that the central banks, when they buy international reserves in treasuries, they are much less price sensitive than the private sector. So we are taking out also this from these measures. Just to be clear, we are working now in the revisions, I said, and then we are separating this from the supply. So it will be kind of an independent component of demand, which then, Ernesto, could be in that psi because, it's a demand that fluctuates over time depending on the preference of the central banks, right? But now we are just taking out from this and to have a unique measure of net supply of safe assets to the private sector. And we just normalize by world GDP because we have a very long sample. So what we get is this. As I said, if you look at the gross debt, after the 80s, it's just increasing. If you look at what goes to the market, then it's very different. You see that it increases here, and then it's stable during the 90s, actually fell until the global financial crisis, and then it's increasing a lot again. And then when you take out the foreign reserves, you see that, the dynamics here is pretty similar. And then since mid-90s, of course, you start to accumulate much more reserves, so this falls more than the marketable debt, and then it goes back. And as I said, if you include the US, the UK, France, and Germany debt, and do the same adjustments that we did for the other ones, you get a very similar picture. It's just a level shift, right? You see, you go kind of 4 percentage points up or less. Okay, so this is our measure. And then if you just plot the measure, you see that the correlation is very high, especially, since mid-70s to the global financial crisis. And then after the global financial crisis, we have this gap. And actually, we will talk about this a bit later, but we'll see that, this gap happens because we have other drivers that push real interest rate down. And actually, if you didn't have this increase in the supply of safe assets, this real rates will be even lower. Then we include also other determinants of neutral rates. The usual ones, productivity growth. We have 4 different variables of productivity growth, looking at both labor productivity and TFP productivity. As I said, we are focusing on the long run, so we take, HP filter with high lambda, and then just take the trend of this of the average of these variables. We use the working age population share as our variable for demographics. We experimented with other variables also, but this one seems to be the one that captures better the demographic trends. We include the convenience field. The convenience field was used by Del Negro and co-authors in a JA paper, and also, Krishnamurti and V.C. Nordenstein were the ones who looked at this first, which is mainly looking at the difference between the corporate and the treasury bonds. We adjust for bond level, maturity, convenience fields. We have a big database, which is similar to Gilchrist's and I don't know how to speak to say the other name ever, but I mean, the GZ spread. And we also focus here on the trend of this convenience yield. So we are not looking at that very wild short-run movements. And then we also include global spillovers, which I will talk about them a bit later. So these are the pictures of what we have. So the range of trend productivity growth is pretty high here, and then it's smaller here. And the trend is, it goes down mostly, but it comes from 4 and stays at 2 for a long time, and then goes down again after mid 2000s. The working age population share, as you see, this kind of captures the demographic transition. So it goes up until mid 90s and then starts to go down. So here you have the baby boom and then people entering the working age population, and then starts to go down after the mid 90s. So this is something that, you see in the model, then this is something that's pushing down into neutral rates since the 2000s. This is the convenience yield. So it goes up until the 70s, then it falls a little bit. It's more or less stable until the mid 90s, and then goes steadily up after that. And this is just, putting our picture of the net supply of safe assets again alone. And it has a trend, going down to the 70s, up until mid 80s, stable, goes down there until the global financial crisis, and then skyrockets again and since then.
Samer, one question.
Yes.
So the development of the international financial markets, or or in different countries, or in the world, it would be here where in the convenience yield, or because we are seeing that since the 60s. So I guess maybe not the US particularly, but other countries would have a very different development, right?
Yeah, that's true. So I think that we can capture this in 2 different ways. One would be this convenience yield going up since the 90s. So it'll be something that, kind of captures an increasing demand for this global safe asset since then, which is the treasuries. And the other thing is that it's kind of inside here, because if I go back, so the difference between the green and the red line, you see that here is more or less stable, which is mainly some countries carrying some reserves. It was not that big until here. And then if you start on mid 90s, you see that the difference increases more, and this is mainly China, Asian countries, and Latin American countries accumulating more reserves since the mid 90s. So we are kind of capturing, at least from the government side, this increase on demand for safe assets here. We are putting directly in the net supply of safe assets, which in a sense just say that this entities are not that price sensitive. So we just say, okay, this is not making prices. And then we can discuss later, because I know that, for instance, Chile particularly has a very different way to invest the reserves, invest in also equities and all that. But we are, in general, we think that they are less, when they buy treasuries, they are less price sensitive than the private sector. So that's the idea. So it will be captured more or less here, but we don't have one variable that said, okay, we had more. I'll give an example. China enters the WTO and then starts to participate in global capital markets. To the extent that the accumulation of reserves captures that, we have it here. To the extent that the convenience yield captures that, we have it here. But apart from that, we don't have it. That's the case. And then the rest would be implicitly captured by the global spillovers thing, but there isn't a variable that brings down that.
Question: what is a safe asset for an advanced economy that is not the US?
so for all the advanced economies, the global safe asset is the U.S. treasuries in our baseline. Okay. So the idea is that they look, and then we also kind of have this question that okay, for Europe it could be the German bonds.
German bonds, yes.
Yeah, not really. So
but what you use is only treasuries.
We use treasuries in the baseline, but as I told you, if we go to the other one, it doesn't change anything. We just focus. This one includes Germany, UK, and France also, and so US, Germany, UK, and France. And you see that the dynamics are, mostly the same. So it's not very different. And then when we in the end, I'll show you some robustness with different estimations, and you'll see that if we include this variable instead of the US alone, it will give you more or less the same result. So it's pretty similar. But yeah, we had this discussion a lot with it. As I told you, the decision to look only at the United States, because then in this TIC data we have very clearly foreign holdings of U.S. treasuries by governments, for instance. So then we can capture reserves, sovereign wealth funds, everything is there already. And when you go to these other countries, it's not that clear. You have to go to the IMF COFER database, and then you kind of have a share in euros, but euros is it only German bonds or is it France? And then you do some approximation. So the measure is is less clean than the US, so they decided to go with the US as the baseline. But you're right. In a sense, if you are, let's say, Spain, probably the safe asset is German bonds, not the US. But what we show here is that at least for this very long period that we look at, they co-move a lot. They are very similar. So that's what we.
Just to add one thing to Samer's point, but also kind of tying back to Andres' question and also yours, Ernesto. So we have also explored, other options of safe assets, like whether they could be really safe assets. For instance, mortgage-backed securities, right? So that's another question that every now and then we get it. It's like, oh, so why don't you use mortgage-backed securities? So what we did was we looked at the literature to see really was this really like a safe asset? And what we find, there's this paper from some folks from the New York Fed who show that the spreads of the MBS against treasuries actually they widened in recessions even prior to the 2008 recession. So this is just to say that, yeah, we looked at other options of other possible assets that we could include. But in the end of the day, what it seems to be really a safe asset is the US Treasuries. And plus, you could add, as Samer said, like the German bonds, you could add the French treasuries, you could add the UK treasuries, and so on. But in the end of the day, it doesn't make a huge difference, as Samer showed you in that figure there. So, yeah.
So, if I can react to that, so what is then the main driver that you guys think is pushing this strong decoupling between neutral rates and the stock of safe assets? Is it a huge change in risk aversion that is pushing demand despite supply peaking, or what? Because none of the drivers, the real drivers that you've shown in the last slide, seems to do the trick for the last decade. You don't see major developments in productivity or working age population, at least not enough as to account for this decoupling. So it's got to be something related to demand, possibly triggered by agents after the GFC realizing that there wasn't that amount of safe assets after all. What is the story, guys?
Yeah, so you're right. So actually we are working on that now. But the idea is that One thing that is important is that the demographic transition is kind of accelerating. So this is one thing that's already here, but it's, I mean, as you said, it's not as stark, right? I mean, if I go back to the picture, it's pretty clear that, I mean, the decoupling, I don't know where it is now. This one, yeah. So the decoupling is much bigger than what we see as the demographic thing. What we're exploring now is some regulatory changes, like Dodd-Frank or Basel III or other that kind of made financial institutions to hold more safe assets. So if I go, let me go. I mean, I'll show you a picture. I have it here for partnership. So this is, I mean, this is not data from ours. That's what we are exploring now. But I would say, for instance, I mean, since 2013, the holdings of treasuries by commercial banks have been increasing a lot. And this is after some regulations by Dodd-Frank. We can see this here also with the financial sector holdings of US treasuries from all financial institutions. I mean, it started a kind of in 2008, right? It was more or less, I mean, stable or declining, and then it starts to increase a lot. The regulations start here, but you could see some anticipation, for example, and then they could start more. So this is something that we are exploring. And also there are some particular regulations, like, I mean, there were some regulations, the money market funds that said, okay, now you have to mark to market what you have. And then people moved from funds that had private bonds to funds that have government bonds because they oscillated much less. So you see this jump here also around 2015. So there are different measures after after 2008 that might have increased the demand for this safe asset. This is not in our analysis now, but it's something that we are exploring the revision of the paper.
Excuse me, Summer?
Yeah.
Yeah. It seems to me that the story could be a combination of things. One of them is the increasing demand, probably because of risk aversion after the global financial crisis. And as you say, the regulation should start kicking in 2014, 2015, when the liquidity coverage ratio of Basel III started to be binding.
Exactly. That's our main hypothesis now. But this is not here in this model. We are kind of in the middle of this review now to try to incorporate this measure, because this is really a question that comes up a lot, and it makes sense because, I mean, there is a very strong movement until 2008, and it's a very long period of time. It's almost 50 years. And then you have this gap just after that. So that's what we are trying to explain now. All right, so this kind of ends the data part, and then I'll go to our empirical model. So this is related to a trend cycle deposition. We based it on the paper by Martin Uribe, which did the same thing for other variables, but I mean, we adapted for our particular case. So we have unemployment, inflation, and the nominal interest rate, and we decompose it, I mean, let's say in a cyclical component, and we have three trends. One is an employment trend, one is a monetary trend, and one is a neutral rate trend. So then, I mean, as you see, the unemployment trend affects only unemployment, the monetary trend affects inflation, but the neutral rate plus the monetary affect the nominal policy rate. The cyclical component is AR1, and we have here some structural shocks, and then we have many exogenous shocks. We have trend shocks and temporary shocks. And the key equation is the equation in the change in the real neutral rate. So, I mean, the change of this variable. And we put more structure here, and then we say that it could depend on the change in observed trend productivity growth, which is that variable that we put that. And we do it, I mean, the productivity is country by country, right? And then we have the change in the working age share, also country by country. Then we have the change in that observed net supply of safe assets, which is global. Then we have the change in the observed trend convenience yield, which is also global because we are looking only at one safe asset, which is the US. And then you have one that is a combination of the changes in productivity and demographics on the other countries. And we just use weights, which are trade weighted in a sense. So we have also one data here, which is so this is spillovers from productivity and demographics of other countries to the US, for example. And then we have also a thought which captures other things. So
Summer,
yes,
let me interrupt you here so I can ask you directly. So if this were to be applied for the emerging economies,
yeah,
you would change this equation probably, right?
yes,
Like here you would have to add some country
risk or
premium
something, yeah.
And other stuff that makes emerging markets different. So what about so we always think about one of the differences that emerging markets or small open economies cannot affect the rest of the world, but the rest of
Yeah.
the world can affect us. So how would you change this equation in order to include that, and what would be the difference with advanced economies that is what you have here?
I guess that I mean these things, for instance, suppose that we got Chile to use the example. So you have the change in productivity in Chile, that's fine, right? Some demographic variables, the change is fine also. This global supply of safe assets will be the same, just because I mean it's only one convenience field also. We'll have this. We could have the spillovers because you're a small open economy, so you receive the spillovers from other countries. You only don't spill over again to them. And then I mean, probably a country risk premium, right? Because we'll and so just to tell some story here, we actually started thinking about including also emerging economies. But in the end, we already, I mean, we had so many parameters here that we didn't end up including much more. But so some measure of country risk, and then it's kind of, I mean, it's kind of harder recently because we used to use the NBI, for instance, but the NBI is not that informative, I guess, more recently than it was, I mean, in the past. So then we'll have to look at something, I don't know, CDS spreads or something like that to capture that. But I've been thinking about that because, I mean, as you know, I work with papers with foreign emerging markets in other papers, and a measure of country risk would be important. Probably in the case of Chile or Brazil or for any other Latin American country, maybe the commodity price or the some measure of terms of trade stock also could be important, right? We kind of see this movement. I don't know if you incorporate that in your calculations or not. Actually, it would be nice to talk about that later to see. I mean, what would you include also? But what I have in mind now is mainly these two things. I mean, the country risk and some measure of commodity prices terms of trade thing. That would be. I don't know if you include other factors also. So this is the main equation, and the idea here is that you can be affected by your own productivity, your demographic transition variable, which here is the working age share, global supply of safe assets, some convenience yield capturing some type of increase in global demand, let's say, and the rest of the world global spillovers. Again, coming back to Andres' question, what we are working now is actually trying to include this measure of, let's say, shift in demand since the global financial crisis, which will be related to this regulations, preference changes, and all that.
Summer, sorry, this is Ernesto again.
Yes.
I am a bit confused. So, quick question. Where do you get the measurement of the neutral rate from?
So we don't have it. This is a latent, right? So we have the observed rate, and then we have the neutral rate, but we impose this structure here. So the latent variable depends on both the variable and an epsilon that it's a shot.
And another quick question is, the model you show us at the beginning, do you use it for something in the paper, or it's just motivation?
No, it's just motivation. Just
Okay,
motivation.
so this is a purely empirical paper.
Yes.
Okay, got it. Thank you.
So then, I mean, if this is clear, then we can go to the shocks and identification. So as I said, we have permanent shocks and transitory shocks. We have monetary shocks, permanent and transitory. We have the unemployment shock, permanent and transitory, and we have the real interest rate shock, permanent and transitory. So we combine some strict restrictions with some sign restrictions here. But the idea is to be, I mean, as conventional as possible. And this is just normalized, right? That's why I have -1 here or -1 there. But the idea is that, I mean, the permanent monetary shock and unemployment shock, we don't have any prior restriction on that. For the temporary shocks, the temporary monetary shocks increase unemployment, decreases inflation, and for sure increases the one-to-one the policy rate. So look, it is a monetary policy shock in a sense. You increase epsilon, and then it should increase unemployment and decrease inflation. By how much, we don't know. The demand shock, unemployment goes down for sure. Inflation might go up or not. And the supply shock, the opposite. Inflation goes up for sure. Unemployment can go up or not. Okay? And then finally, the change in the real neutral interest rate, what happens is that we don't want either unemployment or inflation or the policy rate to move on impact. So we need these restrictions to make sure that, I mean, everything on impact, it's not changing, and then it will change going forward. So it's like, I mean, the central bank doesn't move the policy rate because it doesn't see that movement in the very short run of the neutral rate. Okay. We use Bayesian estimation to estimate everything, and then we common filter representation, and we use MCMC with 1.5 million draws. If there isn't any questions, let me go now to why we use this model versus others. So, I mean, I think we have a lot of different reasons to do that. So simultaneously, we use many neutral rate determinants, and we account also for some uncertainty in this estimates about the relevance. So this is something that, I mean, usually you see papers looking at either demographics or productivity, or, I mean, when put both. And we also, the identification comes much more on this long run drivers than of the identification restrictions for itself. We allow the changes in trends affect the cyclical variables. So it's not just a trend cycle decomposition and then run a regression as we saw in other papers. And I think we also think that's important that we allow global spillovers of neutral rate determinants. And it's something that's not very explored, and I think it refines a lot this the accounting of this global co-movement.
Summer, sorry, quickly. A natural criticism to the approach that you guys are using is that it doesn't necessarily fit at the structural form. And for that, probably the model could help in the sense that you have a compelling model, you derive what is the latent the specification for the latent equation that you guys ran, even with the same explanatory variables, and then go for it.
I see. So if you kind of think that if we should expand a little more on the theory to show that in the end we will have these equations that we have in the empirical part, right?
Right. So even if I agree with these 4 bullet points, which I do, one may say, but the exact form of the specification may be specified.
Okay.
And a natural answer for that would be we use a model to motivate the specification, and then we go for it.
Okay. Okay, that's great. Thanks.
Yeah, so Ernesto, we actually had in the past we had a back and forth about this, like Sam and I, and yeah, as you can see right now, the paper doesn't have it, but we actually had thought about this quite hard. It's like, you could essentially what you could do is like that equation that Summers, like the equation that Summer discussed in that slide on the theoretical model, you could essentially do like a log linearization, and then you could get something very similar to our main equation, equation 6, I believe. So yeah, this equation
Sure.
here.
I agree with you that it's something relatively cheap to do, and it will shut out some mouth.
Yeah. So yeah, this is
Good
just
in
to say,
mind.
yeah, we have thought about it. It's a really cool idea. Thanks a lot, Ernesto.
All right, so let me go now to the results.
Can I ask you a question?
Sure.
So what is behind the net supply of safe assets? Because so far it's like an exogenous thing that will and then you can identify very well that parameter. But I guess it depends not only on the endogenous variable, depending, of course, on the country J that you're using, but also on the other determinants, on the other right-hand variables, right? So I don't see how you can identify that elasticity if you have co-movements between your right-hand variables and endogeneity with the dependent variable.
Yeah, let me try to take a step on that. So the idea is that, I mean, this net supply of safe assets, which is the US treasuries in a sense, an implied assumption is that this is exogenous to these other variables just because the fiscal policy, which is the main driver of this thing in the end, it doesn't depend on these variables. But I mean, if you think that the fiscal policy depends on how productivity trend is going or the aging of the economy is going, which I mean could be, but you should remember that, and we thought about this before, is that we are not looking about Medicare and Medicaid, all that, because this doesn't go to the market. So if the fiscal policy to deal, for instance, in aging goes to the Medicare fund and the Medicaid trust fund, we already took that out. Okay, so this is one thing that's important. But I mean, the implied assumption is that the fiscal policy is not related to what's happening in productivity and the working share population or anything that's functioning outside, because there's, I mean, you go to the Congress, you ask for some different things, you're looking more at smoothing cyclical variations. But yeah, in the end, I mean, there is an assumption behind it that it doesn't depend on these other variables. That's the key thing. I don't know if Thiago wants to say anything more.
Sorry, I got mixed up here with the sound and the video. Yeah, no, I just want to add one thing, which is one thing that we tried, and it's actually in one of the robustness, is that we allowed the net safe assets, net supply of safe assets variable to depend on the cyclical position of the U.S. economy, and it also doesn't make much of a difference. The results are pretty much the same, and actually the marginal likelihood of the model is actually lower because you're adding parameters while not really adding much of an explanatory power. So in the end of the day, we stick with this simpler model. But that's something that we thought about and we explored, and yeah, and we think this is, at least for now, this is the best approach that we can take. But thanks a lot.
All right, so let's go to the results. So we have, I mean, two waves of declines in neutral rates, one beginning in the 60s until the 70s, and then one during the mid-90s, 2000 here. And then it starts to go up after 2008. And and this is true for the US. Here we are showing just some countries: US, Canada, UK, and the euro area. And you can see also that they co-move quite strongly. If we do a historical decomposition, we can see that the safe asset is an important driver of neutral rate. So this is the red bars. So they push down from the 60s until the 80s. Then it pushed it up during the 80s. Then it pushed down again since the 90s until the global financial crisis. And then here you see after the global financial crisis, the supply is always pushing the neutral rate up. It's just that other variables like productivity a little bit, like demographic, as I said, global spillovers also are important to push down the neutral rates during this period. But in the end, we have a neutral rate that is going up. It's not going up that much, but it's going up, which is kind of, I mean, a bit different than what we see in the realized real rate. So this is for the US. I mean, if you look at UK, Euro area, and Canada, you get similar pictures. Talking now about the variance decomposition, as you can see, the net safe asset is important for all the countries. I mean, it's more important for the Euro area, less important for, let's say, Japan. On average, it's 37%. The convenience shield is also important, which kind of, I mean, speaks to the importance of the safe assets market, let's say, together. Productivity is important a lot for Japan, for instance, and New Zealand, but on average also important. It's almost the same as the net safe assets. And the other ones are much less important, but we also have global spillovers important for some countries. And you see that, for instance, for Canada, it's very important. It's 12% of the variation. And also for Australia, which, I mean, these are two kind of almost small open economies also. So you can see that for these countries that are more like a small open economies and are not in the euro area, they are, I mean, the global spillovers are more important. So if there are any questions about that, we do three actually different exercises. Two are counterfactuals that we have, and then one to try to understand how global spillovers are important. The first one is looking at how safe assets availability pushed up the neutral rates after the global financial crisis. So what we did is mainly we did a counterfactual that instead of having that net safe asset supply going up a lot, like we have in this graph here, we just keep it constant as a share of world GDP. And what would happen is that if we did that, the neutral rate would have gone down, let's say, to -1% in the end of 2019. And what we have is actually plus 0.5%. So this gap is explained by the safe assets availability, which is almost 150 basis points. So this kind of explains a little bit the decoupling, because, I mean, as you can see, if we didn't have the decoupling, it would be even lower the neutral rate. But I mean, this is, as I said, there are other variables that are not included here that could also help us explain what happened.
But just to kind of provide another view on this is that the fiscal expansion after 2008 is contributing to a positive. It's contributing for like to a push up in the neutral rates, right? So it also makes sense that we have a rise, at least in our specification, we do have a rise in neutral rates. And this is because of the fiscal expansion that happened after 2008. So then we can agree whether this is too much or too little, but at least in the end of the day, we have something that we can attach explanations, right? If you look at all the papers, what they would do is like they would have some econometric model, and it would with some sort of like friend cycle decomposition and so on, and you get like a number. But then what drives that number is not really clear, right? Here we have the number, and we have what it drives those numbers to. So we can make sense out of why the neutral rate is increasing in this case. But yeah, just to add another perspective.
Okay, and then we do another exercise, which is mainly trying to.
Hello?
Yes.
One question. I'm Benjamin from the Central Bank.
Benjamin.
I recently here in the bank there were some people talking about fiscal deficit and stuff, and one striking like sidelight factor they talk about is that the interest payment of the U.S. government were as a fraction of GDP were particularly stable over the last 20 years.
That's true.
So that's kind of like saying that it's not that more debt is affecting the rates, but it suggests that it's kind of like the opposite. It's like the federal government is taking advantage of lower rates to increase their debt. So in that sense, it will give you like an idea of there's some endogeneity of the supply of safe assets that they only supply as long as the interest rate are low, and the causality is more on that way. So this counterfactual that there's lower supply of assets, but nothing happened with the demand, it could be like some kind of like weird counterfactual maybe.
Oh, I see. Yeah, this is the point, I guess, from Jason Furman and Olivier Blanchard from some presentations that they made recently. What we are showing here is the neutral rate, not the realized interest rate. So this is, I mean, it's a different concept. But what we are just saying that, okay, you might take advantage of a low interest rate in the short run, but at some point of time, the interest rate will go up. So that's I mean, the message here is that, I mean, this is a long run neutral rate. So in a sense, I mean, you could say, okay, so the real rate should go to something like 0.5. And I mean, we've seen that happening if you go to very long term tips, for instance, that inflation index bonds. This has happened. I mean, it's not very cyclical, but in a sense, I mean, the tips rates have been increasing since the global financial crisis. So I mean, the total amount of interest rate paid is more or less stable in the last 20 years. But we're just saying, okay, but the neutral rate's going up. So in a sense, if you keep doing this and the neutral rate goes up more, maybe you have to increase rates a lot to counteract inflation. I don't want to talk about policy here because then I shouldn't do that. But then, I mean, in the case that you have to do that, then the amount of interest rate that you have to pay is much higher. And John Cochran has a similar point, which is mainly that, I mean, it could be low, and then it might skyrocket when you have to roll over this debt going forward because you have a very high amount of debt, and then interest rates are higher in the future, and then you have to pay much more. That's so it's not really the observed real rate that we are talking about here. Is the neutral rate.
But if I may add, I think it was Benjamin who asked, right? So Benjamin, so I think just to add to Summer's point, I think the other issue here is that the effect that you're mentioning is essentially would come down to saying that you would have how can I put this, like a lowering bias, like essentially the bias that comes from the effect is that if this were true, like as a big effect, this would make our results be worse. Essentially, we would not, if this were true, like as a big effect, this would make the relationship between interest rates and say this measure of supply of interest rates like to be equal to zero or even negative, but we're seeing as positive. So essentially what I'm trying to say is that even if this were the case, like there is the bias that could be there is not strong enough to hinder our results. And we do have a discussion about that in the paper. Yeah, maybe this could be the case, but the tendency, where the bias would push us would be against our results, and the fact that we still get results means that it shouldn't be like a huge issue. Do you
Thiago?
understand what I'm saying?
Yeah, Thiago, just one
Yeah, sure.
comment
Thank
on
you.
that.
Could you repeat
Yeah,
that? Sorry.
sorry, just one comment on that. I don't know, but I don't know if I read it correctly, but I didn't see leverage of United States public debt as a percentage of GDP. It started to kick in 2010 from about 60 to more than 120. Could it be?
Well, sure, but if you normalize, if you get our measure, which is this net supply of safe assets, and instead of normalizing it by the world GDP, you normalize by the US GDP, you get something, the levels are going to be different, but the contour is going to be very similar. So again, it wouldn't still be the case. And I think hopefully you're following my argument in the sense that suppose that this is all true, right? That whenever the interest rates are low, then there is more issuance. So then what it would be is there would be this tendency where the interest rates would not rise as much, or they wouldn't fall as much, because whenever they would change, or even the neutral rate, whenever these things would change, you would issue more. So then you would have like a stable, you wouldn't have like a relationship at all between these variables. And the fact that we still see a relationship between them, we interpret as an indication that this effect is not strong enough. But it is a good point.
Yeah, I was thinking on this variable of leverage of the US debt as a risk that could be explaining the decoupling at the end, or the increased interest rate.
As if, I mean, you have a kind of increase of risk premium, and then people will get more precautionary savings because of that, and then this kind of increase the demand. Yeah, that could be also.
Yeah.
I mean, there are a lot of different, I mean, explanation after the 2008 crisis. They have different explanations why people should be more cautious, because I mean it was a very big crisis and all that. As I said, I mean, this is harder to capture, right? Because I mean we don't have any measure that would say, okay, white people are more or less cautious. Which something that could capture that is the convenience yield. But if you take the trend, it's not. I mean, it's increasing, but not that much. But it's here. But we also, I mean, so I think that's a combination of people being more cautious, and then this other regulatory measures that we have here, and that's what we are trying to explore in the next version of the paper. All right, let me go to the next exercise, which is mainly we try to evaluate the global savings glut hypothesis, which is, as most of people probably know, Bernanke's speech that says that, I mean, the savings, especially from emerging market economies since mid-90s, were pushing down the interest rates. So what we do is a counterfactual, say, okay, suppose that the emerging markets don't accumulate more reserves as a percentage of world GDP as they had in 94, and as what you see is that, I mean, then the neutral rate would be higher by about 50 basis points in the end. And here it's kind of 65 in its peak. So we find some evidence that there is this effect of the global savings glut on the neutral rates also. So then there are two balancing effects here. I mean, the expansionary fiscal policy pushed rates up, after 2008, the reserve accumulation since the mid 90s pushed rates down. So these are the two counterfactors that we have, and the good thing, I mean, using our model is that we can actually quantify how much they push down or up interest rates. And then to the last one is just, I mean, I try to evaluate how global spillovers are important on neutral rates. So the contribution for the US, for instance, is, as I said in the beginning, it's around 85 basis points down from the West. They have the spillover from that productivity slowdown that I showed in the charts, and also the acceleration of the demographic transition. So these are the yellow bars in the slide here. All these yellow bars here pushing down. It pushed up a little bit in the 80s, but mostly, I mean, pushing down the neutral rate, especially here and here in the end. Including these global spillovers is a good thing because it prevents us from overemphasizing the supply of safe assets and the convenience yield. So, I mean, when we omit the spillovers, the importance of the safe assets and convenience yield increase by around 10 percentage points, but also the marginal likelihood of the model decreases. So it says that, I mean, the model, I mean, is not doing as well as it was with the global spillovers. And then there are three potential factors. So of course, if you have only the global determinants, the correlation would be 1 by definition. If you allow for just the synchronization of local determinants without the spillovers, the combination will be 0.34. And if we allow for the global spillovers, we have a combination of 0.77. So you see that, I mean, allowing for the spillovers kind of more than double the synchronization of neutral rates across countries. And finally, as I said, we have a lot of different robustness specifications. The baseline is this red, and if we take out the spillovers, the beta for the elasticity of safe assets is more or less the same. If we include long rates, similar. If we, instead of using HP filter, which some people don't like, we use the Hamilton proposed recent filter. It's here, but it's also similar. If we have the advanced economy safe assets, it's almost exactly the same. As Thiago said, if we have some endogeneity in the safe assets, also is this purple line, so it's also very close. If you change the legs of the model, also that. And then if we, instead of using the working age populations, some people use the birth rate, and we also included that, and we also get something very similar. So I mean, just showing that across very different specifications, and we get the elasticity very close on the net supply of safe assets. So to conclude, we find that the supply of safe assets is an important determinant of neutral rates and robust to several alternative specifications. The global accumulation of reserve pushed down neutral rates. The increase in US debt or the fiscal expansion since the 2008 crisis pushed up neutral rates. The global spillovers are important determinant of neutral rates. And the implication, we already discussed this a little bit. So we have all these discussions of R less than G, and interest rates have been more or less, payments have been more or less constant. So it's just, I mean, some note of caution here that, I mean, it looks like higher debt capacity, but the debt may increase the neutral rate, and then on consequence, the interest rate that you pay on your debt in the future. And then also that's something that we are working now. So if you move from the savings and investment framework to this demand and supply frameworks, then, I mean, demographics could be a demand shifter. Regulation, as I said, I mean, we are evaluating how we can account for this demand shifter by itself, and could have other demand shifters also that we could discuss in the future. So that's what I have. I don't know if we have further questions, comments.
Hello.
Hi, Benjamin.
Hi. One extra question is relevant to the what you just said, that if you put different kind of safe assets, like just like advanced economies, I think that probably that's European assets, it doesn't change anything. How
No,
do you think that would relate to the idea of governance and sustain of the dominant currency and the effect that that should have on differential valuation of safe assets in different currencies?
yeah, I mean it's related in a sense, but we don't want to take a very strong stance on that. But as I said, I mean one reason to use the treasuries as the baseline is this global dominance of U.S. dollar in trade and let's say the national financial system, which is based on Gohincha's, Gopinath, and Ellen Ray work. But we also think that there is some arbitrage between the interest rates. I mean, it's not complete arbitrage, but I mean, there is some arbitrage between the treasuries and the German rates and the UK rates and the Sweden rates. So I mean, in a sense, I mean, that's why we have this global spillovers effect there to capture more or less this thing. And there is a paper by Altfeld, I guess, in 2019 that actually has a two big countries models that shows, I mean, the mechanism behind that. But the idea here is that, okay, I mean, the U.S., we are using the U.S. in the baseline because it's the dominant currency for trade and financial system. But I mean, for some people that also think that the German bonds are important, especially for European countries, or the French debt, or the UK debt, we include that, and then we find that, I mean, the results are very similar. So I mean, I think it's robust to different views on this dominant currency paradigm, let's say.
But I don't know if you try, but maybe the reason that you get the same is just as you say, because the dollar safe assets are so much bigger that basically takes up everything. But you could like maybe do two kind of safe asset in the same regression and see if the elasticities are different. Maybe the dollar safe asset supply changes are maybe different than other currency supply changes. It's particular, of course, to countries other than the US.
Yeah, we didn't do that. We just put everything together. But yeah, it might be the case that it could be different. That's a good suggestion. Thank you.
Thank you. Thanks for that.
Andres?
Yes, thank you very much. Very interesting paper. Also, thanks to Thiago for showing up. I have a final thought regarding policy implications of this. So, so Caballero and company, they have, they make a pretty strong case for policy action to counteract this this trend in neutral rates. They claim that a consequence or potential effect of this downward trend in neutral rates is to have like a stagnant global economy, right?
Yeah, the safety trap thing.
Exactly. So they come up with some policy suggestions. One that I recall is the consideration of private safe assets, right? Which is something that you guys have abstracted from the analysis. The interesting angle that your work provides is that in retrospective, apparently there has been quite a bit of action on the supply side, right?
Yeah.
More than perhaps their work allow us to think about.
Yeah.
Have you guys thought about their policy advice? They also talk about global coordination in accumulation of reserves, right? In conjunction with these private assets, safe assets, compelling foreign governments to accumulate reserves not in sovereign debt, but in private debt.
Yeah.
Have you guys given any thought to this?
So we didn't include this in the paper, but in a sense, the two counterfactual exercises that we do speak to that, right? So this one said, okay, if you increase a lot the availability of public safe assets, neutral rates go up, and then you have much more policy space to, lower policy rates and then stimulate the economy and then go out from the safety trap. So this is one thing. So in a sense, if you are able to manufacture private safe assets and you include in the supply of global safe assets, private safe assets, it would push up the neutral rate, right? And this would be kind of what they have also in their model. The same thing with the reserves, right? If instead of each country accumulated their reserves, then you do something like a pool of reserves, or you accumulate reserves in other assets like private safe assets and all that. Same thing. If you haven't accumulated so much reserves, the neutral rate would be higher. So in a sense, we are speaking to them doing these two exercises. We don't want to push a lot on policy implications in the paper, but as you said, the two ones that you cited that are on their work, it's mainly the two counterfactuals that we do here.